This wasn't bad business. It was one of the biggest corporate frauds ever. In 2002, a corporate giant collapsed almost overnight. Not because of a market crash, not because of competition, but because of a lie. This is the story of WorldCom and an $11 billion accounting fraud that became the largest bankruptcy in history at the time. WorldCom was once one of America's most powerful telecommunications companies. Based in the United States, it grew rapidly during the 1990s internet boom. It handled long-distance calls, internet traffic, global communications. Investors trusted it. Analysts praised it. Employees believed it was unstoppable. But behind the scenes, WorldCom was in trouble. Growth slowed, competition increased, and profits began to disappear. Executives faced pressure to meet expectations, pressure to keep the stock price high, pressure to hide the truth. Instead of reporting losses, WorldCom manipulated its books. Between 1999 and 2002, the company inflated its assets by more than $11 billion. The method was simple and devastating. WorldCom took everyday operating expenses, costs that should have been recorded immediately, and falsely classified them as long-term investments. On paper, this made the company look profitable. In reality, it was bleeding money. Investors saw strong earnings, the stock stayed high, executives received bonuses, and no one questioned the numbers. Until someone did. In 2002, internal auditors discovered massive irregularities, expenses that made no sense, entries that had no justification, numbers that were too good to be true. When the fraud was exposed, the reaction was immediate. WorldCom admitted it had overstated earnings by billions. The market panicked. The stock collapsed. Within months, WorldCom filed for bankruptcy. At the time, it was the largest bankruptcy filing in U.S. history. More than 30,000 employees lost their jobs. Investors lost billions. Pension funds were wiped out. Executives were charged. Top leadership faced criminal prosecution. Some received long prison sentences. WorldCom itself ceased to exist in its original form. It was later absorbed into another company, but the damage was permanent. The scandal exposed deep failures. Auditors missed warning signs. Regulators reacted too late. A corporate culture rewarded short-term success over honesty. WorldCom became a global lesson, taught in business schools, referenced in financial regulations, used as a warning of what happens when oversight fails. This was not just accounting fraud. It was a betrayal of employees, of investors, of the public trust. The collapse helped trigger major reforms in corporate governance and accounting standards. But it also revealed a darker truth, that massive fraud can exist in plain sight, hidden behind spreadsheets, and signed off by executives. WorldCom is remembered not for innovation, but for deception, an $11 billion lie, and a collapse that shook the financial world. If you want more real stories of corporate fraud, financial scandals, and true crime investigations, subscribe to the channel and comment below. Do you think fraud like this could still happen today?